All right, this week's real estate and mortgage rate update. This is going to be a quick one, but big news. The rates are moving in the right direction. 6.5. We had a slight move up today. This is as of today. Again, national average 30-year fixed rate mortgage, basically 6.5%. Trending in the right direction. Here's why, and I talked a little bit about this last week, that the Jackson Hole Economic Symposium, they met all last week, and then the Fed President Jerome Powell, he did his testimony on Friday, and in that testimony he got quite a bit more kind of dovish, meaning a little bit more soft on cutting rates, meaning he's kind of vacillated back and forth and taken a really strict stance on rates, and now he's started to soften. And the biggest reason why that he notated was, well, two reasons. The biggest reason is softening in employment. We've talked about this. We've talked about the crazy revisions that we had seen over 2023 and 2024. Well, those revisions have continued. In fact, May was revised lower from 145,000 new jobs created to 19,000. And June was revised from 147,000 jobs created to 14,000 jobs created. So clearly, the firing of the BLS was probably a good move. A lot of people are taking it as a political move. The reality is that it's a failed way of data collection. They've kept with it, and they've continued to have these horrific revisions. And unfortunately, what happens is the market reacts to the initial news, and then it kind of just, as these revisions come in, it doesn't even make any headlines. And so the market's already reacted, and it doesn't kind of retreat from that. And so we see these spikes in rates. Well, when the Fed chair spoke on Friday, you can see massive movement up. And again, mortgage rates are based on a bond. This is a real-time trading feed of mortgage-backed securities that direct the rates of bonds. And so you've got this massive move up, which is good for rates. Green and up is good for rates. Red and down is bad for rates. So great move. You can see, though, and this is something to take into consideration, is you can see that when we broke above this ceiling right here, it became a floor, and it kind of tried to break down, each of these, and it just kept getting rejected back up, which is really good, until it fell below here, and then it stayed below. Took this news to break back up. This created a ceiling, and then it broke above this, but now you can see this ceiling has kind of pushed it back on both Friday afternoon as well as today. But it's trending in the right direction. The key economic releases coming up are going to be a couple inflation reports and the next month's job reports. Those are going to be very closely monitored, but it's all been said that there's going to be a 1/4 point cut in September. And, there's a lot of discussion, and I hear it on the street all the time, that people think that when the Fed cuts rates, mortgage rates come down. It doesn't work directly like that. However, because rates have been so high and the cost of borrowing, because of the Fed funds rate being so high, construction costs are higher. All of people's budget expenses outside of the home are higher. Car loans, credit cards, things like that. And so it's just really constricted the monetary supply. As we start to see that free up, we'll start to see people make decisions in real estate. And, certainly with the 10-year here softening on Friday as well, that helps mortgage rates in the long run. So stay tuned. We're continuing in the right direction. I love to see this trend. Hopefully we can continue to see it with the next couple inflation reports. Those are going to be really key because we don't want to see spikes in inflation because that'll kind of push things back down. All right. Thanks so much. Talk to you soon.